Welcome to the deep dive. Now, when you think intelligent investor, you might picture, I don't know, some Wall Street genius glued to flashing screens.
Right, the sort of high-octane image.
Exactly.
Mhm.
But today, we're looking at a totally different kind of intelligence, the kind that actually builds lasting wealth and, maybe more importantly, peace of mind.
hmm And our guide for this is The Intelligent Investor by Benjamin Graham. You know, the guy who mentored Warren Buffett?
That definitely gives him some serious credibility.
It does. And Graham's core idea, it's pretty profound. He said, the investor's chief problem, and even his worst enemy, is likely to be himself.
Wow. Okay, so this isn't just about picking stocks then.
Not at all. It's really a deep look into our own psychology or behavior when it comes to money.
Okay, so our mission here isn't about making you a day trader overnight.
Definitely not.
It's about pulling out Graham's key principles so you can become a more, let's say, grounded and effective investor, no matter where you're starting from.
Sounds good.
So let's start with that word, intelligence. What did Graham actually mean by an intelligent investor? It's not just IQ points, is it?
No, not in the way we usually think about it. Graham, well, he kind of flipped the script. For him, investment intelligence wasn't about having the highest IQ or, complex financial models.
Okay.
It was really about emotional discipline. Can you stay calm? Can you be rational, patient? Especially when the market is, going haywire.
That's interesting.
Yeah,
So less about complex calculations and more about keeping your cool.
that's a huge part of it. Think about it. How often do fear and greed drive people's investment choices?
All the time, probably, leading to mistakes.
Big mistakes, often. Graham saw that emotional roller coaster as maybe the single biggest obstacle for most people.
Okay, give us an example. How does this play out?
Well, cast your mind back to, say, 2008, the financial crisis.
Right. Panic everywhere. Markets plunging.
Total turmoil. And while lots of people were, understandably, freaking out and selling everything, Warren Buffett, Graham's star pupil, remember he wrote this op-ed in the New York Times? The headline was basically, "Buy American, I am."
Huh. Talk about going against the grain.
Exactly. He wasn't reacting to the fear. He saw massive opportunity because prices were depressed. That's pure Graham. Be fearful when others are greedy, and greedy only when others are fearful.
But doing that takes serious guts, emotional strength.
Immense emotional fortitude. It's easy to say, incredibly hard to do. So, yeah, the real insight is that emotional stability, that level-headedness, that's the hallmark of a truly intelligent investor, according to Graham.
Okay, that makes sense. Which kind of leads us nicely into another one of Graham's really brilliant ideas, this character he called Mr. Market.
Ah, yes, Mr. Market. It's such a fantastic allegory.
Explain him to us. Who is this guy?
Okay, so imagine you co-own a business with this partner, Mr. Market, and every single day he shows up and tells you what he thinks your share is worth.
Every day.
Every day. And he offers to either buy you out at that price or sell you his share at the same price.
Okay, what's the catch?
The catch is, Mr. Market is, well, kind of manic depressive. Some days he's wildly optimistic, just euphoric, and quotes these ridiculously high prices. Other days he's incredibly gloomy, sees nothing but trouble ahead, and offers you prices that are just absurdly low. He practically wants to give his shares away.
So he basically represents the stock market's mood swings, the short-term volatility.
Perfectly. He embodies that often irrational emotional fluctuation we see day to day.
And Graham's point was,
Graham's crucial point is this. You don't have to do anything based on Mr. Market's mood that day. His offer is just an offer. You're not obligated to trade with him just because he showed up feeling manic or depressed.
don't get swept up in his emotion.
Exactly. You're the owner. You should focus on the business's actual value, not Mr. Market's daily whim.
That's a powerful way to frame it. Helps detach you from the noise. Can we think of a modern Mr. Market?
Oh, absolutely. Think about social media sentiment around certain stocks or crypto, maybe.
Yeah. How so?
Well, you see these waves of extreme hype, right? Something's going to the moon, everyone's piling in, fear of missing out is rampant, Mr. Market is ecstatic.
Right.
Then maybe some negative news hits or just a shift in mood, and suddenly sentiment flips completely. Panic selling, negativity everywhere, Mr. Market is in despair. Social media often amplifies these swings dramatically.
It's the same dynamic, just faster and louder, maybe.
Pretty much. It bombards you with these emotional reasons to buy or sell right now.
So the big takeaway when we're facing our own Mr. Market, whether it's CNBC or Twitter or just our own gut reaction, what should we do?
Resist the urge to be swayed by his mood. The key is to focus on the intrinsic value of what you own.
Intrinsic value, meaning?
Meaning the real underlying worth of the asset based on its fundamentals, earnings, assets, future prospects, separate from whatever the market is pricing it at today. Know what you own, why you own it.
And use Mr. Market.
Use him. Don't be used by him. He's there to serve you. If he shows up feeling irrationally depressed and offers you a bargain price for something you know is valuable, maybe you buy. If he's irrationally exuberant and offers you a crazy high price for something you own, maybe you sell. But you decide based on value, not his mood.
Okay, so emotional discipline, ignore Mr. Market's tantrums, focus on intrinsic value.
Yeah.
Got it. Let's move to another pillar of Graham's philosophy, the margin of safety. Sounds important.
Oh, it's absolutely vital. You could argue it's Graham's single most important principle for actually, protecting your capital.
Protecting capital. Okay.
Yeah.
What is it exactly?
In simple terms, it means buying an asset for significantly less than what you've carefully estimated its underlying value, its intrinsic value to be.
So it's like finding something you think is worth, say, $100, but you manage to buy it for $70 or $80.
Precisely. That $20 or $30 difference is your margin of safety.
And why is that gap so important?
Because it acts as a buffer? A cushion. Look, your analysis might be flawed, right? Nobody's perfect.
True.
Or maybe something unexpected happens. An economic downturn. A problem with the company. Just plain bad luck. That margin of safety protects you against errors and misfortunes. It limits your downside risk.
Can you give a real-world example? Maybe with Buffett again.
Sure. Buffett's entire approach is built on this. Think about his long-term investment in Coca-Cola. He bought heavily when he felt the company, with its incredibly strong brand and predictable earnings, was undervalued by the market.
Even if the stock price was maybe flat or down temporarily?
Especially then. He wasn't just buying a great business. He was buying it at a price that gave him a substantial margin of safety. He knew the value was there, even if Mr. Market was pessimistic at the time. That reduced his risk enormously. And, well, the rest is history.
So it shifts the focus. Instead of just thinking, how much can I make? You're also thinking, maybe first thinking, how much can I realistically lose?
Exactly. So many people are laser focused on maximizing returns. Graham flips that. He emphasizes minimizing the chance of irreversible loss. Minimizing regret, you could say.
That's a really profound shift. The best investors prioritize not losing money.
Over the long run, that's often the path to the best gains too. The margin of safety is your primary tool for doing that.
Okay. Now, Graham also talked about two different types of investors, the defensive and the enterprising. What's the difference there?
Right. He recognized that, people are different. We have different amounts of time, different levels of interest, different expertise when it comes to investing.
Makes sense.
So the defensive investor is basically someone looking for safety and freedom from effort. They want decent results, but they aren't looking to spend hours researching stocks. It's more passive.
So maybe someone newer to investing or just someone busy with other things.
Absolutely. For the defensive investor, Graham suggested things like a simple portfolio mix, maybe high-quality bonds, and a diversified basket of leading stocks. Think index funds, perhaps. Low effort, low stress.
Keep it simple, stay diversified.
Pretty much. Consistency, avoiding big mistakes, achieving average market returns, which, by the way, is better than most people do.
Okay, and the enterprising investor. Sounds more involved.
It is. The enterprising investor is willing to put in the time and effort to do deep research. They're actively looking for situations where the market is significantly undervaluing a security.
So digging into financial reports, analyzing specific companies.
Yes, trying to find those specific opportunities that the average defensive investor wouldn't uncover. It requires more skill, more effort, and, frankly, a different temperament. Maybe looking at smaller companies, special situations, things like that.
So one isn't necessarily better than the other.
Not at all. The crucial point, and this is really for you listening, is to be honest with yourself.
About what?
About how much time, energy, and genuine interest you have in actively managing investments. If digging through annual reports sounds like torture, then trying to be an enterprising investor is probably a mistake. There's absolutely nothing wrong with being a successful defensive investor. In fact, a disciplined defensive strategy, like regularly investing in low-cost index funds over decades, will likely outperform the vast majority of people who try to be enterprising but maybe don't have the skill or discipline.
That's actually really freeing to hear. You don't have to be a stock-picking genius.
Not at all. It's about self-awareness. Match your strategy to your personality, your resources, your timeline. That's intelligent investing.
Okay. Let's talk about discipline then, because sticking to any strategy, defensive or enterprising, requires it. Graham had a great quote about the crowd.
Ah, yes. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right.
Powerful. So don't just follow the herd.
Exactly. Have conviction based on your own homework, your own rational analysis.
Yeah.
Even if it feels uncomfortable, even if everyone else is doing the opposite.
That sounds psychologically tough,
Hmm.
especially when the crowd seems to be making money doing something else.
It's incredibly tough. That's where the discipline comes in. Tuning out the noise, resisting the urge to constantly tinker or chase the latest hot thing, sticking to your well-thought-out plan.
Can you illustrate how that discipline pays off?
Sure. Let's take a simple example. Imagine someone just consistently invested $500 every single month into a broad S&P 500 index fund.
Okay.
And they started doing this back in, say, 1990, and just kept doing it through thick and thin all the way to 2020. 30 years.
Through boons and crashes. .com bubble, 2008.
Everything. Now, someone trying to time the market might have jumped out during the crashes, maybe missed the recoveries, tried to guess the tops and bottoms.
Right. Get whipsawed.
Probably. But our disciplined, consistent investor, by simply sticking to the plan, focusing on time in the market, not timing the market, they likely would have ended up with a very substantial sum, possibly well over $1 million.
Without any special genius, just discipline.
It's steady, boring, unemotional discipline. It's remarkably effective over the long haul.
Okay, finally, let's talk about something that might seem a bit soft. Peace of mind. Graham actually saw this as a key goal.
He absolutely did. Look, what's the point of potentially higher returns if you're constantly stressed, losing sleep, worried about the next market crash?
Yeah, that doesn't sound like a great way to live.
Right. Graham argued that the best investment strategy for you isn't necessarily the one with the absolute maximum theoretical return. It's the one you can actually stick with calmly over the long term, one that lets you sleep at night.
So financial well-being isn't just the number in your account. It's also about serenity.
Serenity might be a good word. It links back to his main point, doesn't it? The investor's worst enemy is likely to be himself.
Because we sabotage ourselves.
Often, yes. Trying to be too clever, chasing fads, panicking at the wrong time. These actions rarely lead to long-term success, and they certainly don't lead to peace of mind.
So what did Graham suggest for achieving that kind of investing zen?
Well, avoid speculation. That's a big one. He made a clear difference between investing, owning a piece of a business based on value, and speculating, betting on price movements.
Okay.
Ignore the daily market noise. Focus long-term. Invest only in things you genuinely understand, and, maybe counterintuitively, embrace being a bit boring.
Boring but rich.
Boring but rich, and hopefully boring but calm. Consistent, sensible investing in solid assets is far more likely to get you where you want to go, financially and emotionally, than chasing excitement.
Okay, so wrapping this all up, our deep dive into the intelligent investor shows it's not about secret formulas or predicting the future.
Not at all. It's really a timeless guide built on discipline, patience, rational thinking, and crucially, self-awareness.
Understanding the market's tendencies, like Mr. Market.
Yeah, and understanding your own tendencies. And then using tools like the margin of safety to protect yourself from both.
And that core,
Right.
true investment intelligence is fundamentally about emotional strength, right? Staying rational when things get scary or euphoric.
That's the heart of it. Which leads to maybe the most important question you can ask yourself after hearing all this.
Which is?
Am I really investing? Or am I just speculating? It's worth some honest reflection.
Definitely. And maybe a practical next step for everyone listening could be,
Yeah.
what? Review your holdings.
Yeah, review what you own. Why do you own it? Define your actual time horizon, your real tolerance for risk. And then find one specific way to increase your margin of safety.
Like what? Diversifying more, looking at index funds if you haven't, setting clear rules for yourself.
Any of those could work. Just take one concrete step towards a more disciplined, safer approach.
It strikes me that these principles, emotional control, discipline, long-term thinking, avoiding panic, they're not just about investing, are they?
Not at all. They're really life principles, aren't they? Useful for navigating all sorts of challenges and uncertainties way beyond your portfolio. Makes you think.